Hey everyone, welcome to this explainer. Today we're totally demystifying the stock market. We're going to break down a really sneaky, fully automated roadmap to long-term wealth. This isn't just about protecting your cash from the rising cost of living. It's about literally putting your money to work for you while you sleep. Let's get into it. Okay, wrap your head around this number. Over $1.8 million. No, that is not a lottery jackpot, and it definitely isn't the result of some crazy, wildly lucky gamble. Honestly, this is exactly what investing just $250 a month, starting back in 1985, would have effortlessly compounded into today. And get this, that staggering figure actually includes surviving every single major historical market crash over the last few decades. The secret ingredient? It's just time and consistency. So here is our roadmap for today. We'll be covering the hidden cost of saving, the pre-investing checklist, the index fund strategy, automating your wealth, surviving market crashes, and finally, when to finally sell. Let's jump right in. Okay, let's dive into this with section 1, the hidden cost of saving. You know, there's this massive misconception out there that keeping all your money in cash is the safest bet. But because of inflation, which, by the way, has averaged around 3.8% a year over the last 60 years, traditional saving is actually a losing game. It's essentially a silent theft. Let me tell you about a hardworking guy named Mervin. To provide for his family and avoid what he considered risk, Mervin worked a factory job, ran a side hustle, and literally stashed all his extra cash in a shoebox, plus a basic bank account paying zero interest. His big dream was to one day quit that factory job, but what he completely failed to realize was that his money was bleeding value every single second. He was playing an incredibly risky game without even knowing it. And sadly, because of that, he was never able to quit. So the crucial point here is that the choice is stark. The old way, the shoebox method, basically guarantees an average loss of 3.8% of your purchasing power every single year to inflation. Now contrast that with the stock market, which historically grows at an average of 8 to 10% annually. See, when you invest, your money earns interest. And then here's the crazy part, that interest earns interest. It is the sheer magic of compound interest. Look, in a perfect world, a regular bank savings account would pay you 10%, right? But those just don't exist. The stock market is really the only reliable vehicle for the everyday person to beat inflation and achieve that massive compounding growth. Which brings us to section 2, the pre-investing checklist. Now, before you just go jumping into the market, there is a strict prerequisite checklist we need to go over. Step 1, wipe out any high-interest debt, like those 15% credit cards. There is absolutely zero point in trying to make a 10% gain in the stock market if you are simultaneously paying a credit card company 15% in interest. The math just doesn't work out. Step 2, build a 3 to 6 month emergency fund. This is absolutely critical, folks. You do not want to be forced to panic sell your hard-earned investments just because, say, your car broke down. And step 3, open a tax-advantaged account. Whether that's a Roth IRA in the US or a stocks and shares ISA over in the UK, these accounts let you legally avoid paying taxes on your massive investment gains. Seriously, use them. So you might be wondering, how much should I actually invest? Well, you don't need to lock away every single penny and live like a hermit. A fantastic, highly practical rule of thumb is the 70-20-10 split. Basically, 70% of your income goes to your living expenses, 20% goes straight into your investments, and that remaining 10%, that's for the fun stuff. Our source material makes a really great point that building wealth shouldn't stop you from living a great life, whether that's flying airplanes, racing cars, or just traveling the world. This budget equips you to build serious wealth without sacrificing your happiness today. Moving right along to section 3, the index fund strategy. To really demystify how this strategy works, I absolutely love this quote from our source material. If you've ever looked at a sports league table, or even just a music chart on Spotify, you actually already understand index funds. Think about it. When a sports team plays brilliantly, they climb to the top of the league. If they play terribly, they get relegated and basically kicked off the list. An index fund works the exact same way. Just swap out the sports teams for massive companies. It is an automated, self-cleaning list of the best-performing businesses in the entire world. Let's look at the most famous league table of them all, the S&P 500. This is a list of the 500 largest public companies in the USA. We're talking the real big dogs here: Apple, Amazon, Google, Tesla. Now, sure, you could try to pick just one of these companies to invest in, but if something terrible happens to that specific company, you can pretty much wave goodbye to your money. The strategy here is to be a little bit sneaky. With an index fund, you can invest in every single company on that list with just one click. You own a tiny slice of all 500. So even if a few of them do terribly, it's completely balanced out by the companies that are doing exceptionally well. Now, what's really interesting about this next point is that you totally think paying a high-fee professional on Wall Street would get you the best returns, right? Well, the irony is that they don't. The data shows that the average actively managed fund actually returns 2% less per year than the general market. Yeah, these high-paid professionals are statistically doing worse than a completely hands-off index fund. Because index funds are passive and just naturally track the market, they don't need a massive team of experts. That means the fees you pay can be incredibly low, sometimes just 0.2% per year. It is literally the ultimate low-effort, high-reward strategy.
All right, let's hit section 4, automating your wealth.
Just £5 a day. That is roughly the cost of a daily Starbucks coffee. Our source material highlights this incredible experiment run by the host's son. He simply set his app to automatically invest £5 into an S&P 500 index fund every single day. He just set it up and entirely forgot about it. Within just 3 months, without even noticing the money leaving his account, he was up over 5%. Automating a tiny daily or monthly deposit means your wealth grows silently and consistently in the background. It completely removes the temptation to spend it or the emotional roller coaster of trying to time the market. Now, if you're wondering exactly which index funds to automate your money into, here are the big 3 discussed in our source material. Number 1 is the S&P 500, which we just covered. It tracks the top U.S. companies and is a bit tech-heavy right now, which is driving massive growth. Number 2 is the total stock market index. This is the absolute definition of maximum diversification. You're buying a tiny piece of virtually everything, everywhere. And number 3 is emerging markets. These are definitely higher risk, but they offer massive potential. To give you an idea of why you might want exposure here, 20 years ago, the host looked at real estate in Shenzhen, China, priced at $47,000. Today, that exact same real estate is worth over $1 million. Having a slice of emerging markets ensures you don't miss out on that kind of explosive global growth. Which brings us to section 5, surviving market crashes. And this brilliantly illustrates one of the biggest beginner fears. Look, it's so easy to panic during a crash, but if you started investing in 1985, look at what you would have faced. Black Monday in 1987, literally the biggest one-day drop in Wall Street history. Then the dot-com bubble burst in 2000. Then the devastating 2008 financial crisis. And then, of course, the massive 2020 COVID crash. During every single one of these events, people were screaming on the news for you to pull your money out. But if you ignored them, held strong, and just kept investing, the market eventually soared to set new record highs every single time. Long-term hold strategies endure the storm. Time in the market always beats trying to time the market. Finally, section 6, when to finally sell. So when do we actually pull our money out? If you're in your 20s or 30s, you really shouldn't be treating your investment account like a checking account. You've got to embrace a buy and forget mentality. There are really only 3 valid reasons to hit that sell button early. Number 1, a true dire emergency, though hopefully your 3 to 6 month cash emergency fund covers that first. Number 2, you picked an individual stock that is a genuinely bad investment and the entire wider industry is in terminal decline. And number 3, you've achieved a specific, predetermined goal like hitting a target figure to buy a house. Outside of these 3 reasons, do not touch it. Do not panic sell. Just let it grow. I want to leave you with one final, really important question to sit with. In your younger years, the biggest risk you can take is not taking enough risk. We saw what happened to Mervin's cash, right? And the data totally proves that an automated index fund strategy bounces back from every crash and builds immense wealth. So are you ready to step onto this automated roadmap and let time do the work for you? Thanks so much for joining me for this explainer. Now go out there and start building your wealth.